Welcome to Multiple Perspectives. This is your weekend view, where we bring you the latest insights and trends in real estate investing. I'm Daniel Brereton. If you are like most investors, you invest to get an attractive return on your money. I don't know of anyone that would invest if they knew they were going to lose money. But what's an appropriate return for a given investment? You might have heard or read about risk-adjusted returns. The idea is to take the risk of various investments into account to compare them to each other. Take, for example, a government bond paying 5% for 5 years. And on the other hand, GameStop stock returning 8,363% in 2020. With just those two numbers, which is the better investment? Of course, you know that betting the house on GameStop is crazy. But you also are likely not satisfied with sticking to treasuries for your entire investing life. What's missing from the comparison of treasuries and meme stocks is the risk associated with the two. Government debt is typically seen as risk-free, and government treasuries don't have the same volatility as stocks and other investments. GameStop stock, on the other hand, is incredibly volatile. The price moves around a lot, and you don't know what your return might be from one day to the next. In commercial real estate, particularly in the private markets, we don't have the same measure of volatility as the public markets. In fact, the measurement of returns in the private versus the public markets is different too. Public market returns often use a compound annual growth rate, or CAGR, over the holding period to measure the return and then use the volatility of those returns as the measure of risk. Private markets use what's known as the internal rate of return, or IRR, to measure the return of the investment. Risk is a bit trickier to hammer down. We will often look at debt coverage, spreads to cap rates, loan to value, and other measures to assess the risk of a deal. But these are mostly measures for margin of safety. The variability of returns is not as easily captured. What our real estate team looks for and what they mean when they discuss risk-adjusted returns in real estate is having an attractive enough return with tolerable valuations that provides a margin of safety for the given investment. And an attractive return is thus defined using a specific return hurdle based on the quality of the investment, the property, the sponsor, and the market. So when you're assessing a deal, take a moment to look beyond just the size of the IRR that's being presented. Take a look at the market. Take a look at the sponsor, the assumptions of the deal, to see what the risks are and whether the return properly compensates for those risks. If you're interested in learning more about our upcoming offerings, we'll be sending out an offering announcement in the coming week. And the only way to receive that email is, of course, to sign up for an Equity Multiple account. Once you've made your account, you can view any of our current offerings on our website, equitymultiple.com. And as always, you can contact us with any questions by emailing ir@equitymultiple.com. Thanks for tuning in to Multiple Perspectives. Join us next time for more insights into the world of real estate investment. Have a great weekend.
This communication is not to be construed as an offer to sell or the solicitation of an offer to buy any security or provide investment advice. Any such offer or solicitation can only be made by means of the delivery of a confidential private offering memorandum. To the extent that performance information is contained in this podcast, past performance is not necessarily indicative of the future results, and all figures are estimated and unaudited unless otherwise noted.